DSCR refis. Hey, what's going on, everybody? It's Jeff Javarthan, Jeff the Mortgage Pro. Thanks so much for watching me today. Today we're going to talk about DSCR loans, in particular the refinance portion of these things. Now, there's two different types of refinances that you can do, and these are the same for most mortgages in general anyway. We have what's called a rate and term refinance, in which we are just trying to lower our interest rate or improve our terms on our from our existing loan. That's a rate and term refinance. We're not taking any money out. And then on the other side, we have what's called a cash out refinance. And in that instance, we're going to tap into some of the equity that we have in the property, and we're going to use a DSCR loan to be able to do that. Okay. DSCR, if you don't know, stands for debt service coverage ratio. And what it is, it's a loan that looks specifically at the cash flow of the property itself against the principal, interest, taxes, and insurance of the debt going on the loan. Okay. So if we have a positive cash flow, meaning that our income that is coming in from the property is $1 greater than the principal, interest, taxes, and insurance going out on the property, then we can probably qualify for a DSCR loan, whether it's a rate term refinance or it's a cash out refinance. Okay. So let's go through some of the guidelines for both of these types of transactions. And I'll try to mention both of the instances where it may vary slightly, but for the most part, they're the same type of guidelines. So we can do loan amounts up to $2 million on the DSCR. Okay. That's both for a cash out refinance and for a rate and term refinance. This is for investment properties only. Okay, so it varies between the two different types of investment properties you might have with the DSCR loan. So we have what's called a long-term rental property. That means that you have a renter in there. You probably have a year lease or maybe a 2-year lease or something like that. And that person is paying every single month the same amount on that property. And then we have a short-term rental, or also called a vacation rental, where there may be some variability in the income, but the income is probably going to be higher on the short-term type of rental property. So you can both do a rate and term refinance on that, and you can do a cash out refinance on that. If we're doing a rate and term refinance, we're probably sticking close to 80% of the value for a rate and term refinance or less. Probably better if you can get to 75% loan to value, meaning you have 25% equity on the rate and term refinance. On the cash out refinance side, we're probably going to be able to go up to a maximum of 70%. So you have to keep that in there. 70% loan to value means that you still have to maintain 30% equity in the property. There's a very couple lenders that will do up to 75% cash out, maybe even one that goes up to 80 cash out, 80% loan to value, meaning you have 20% equity. They're few and far between. The terms are not that great, but it's still possible to cash out up to 80% loan to value if you really need to. And we can look into that if that's something that you're interested in. Just make sure you reach out to me on that one. Okay. So this is for just about all different types of residential property. It's for single family units, 2 to 4 units, condos, townhomes, PUDs, etc. I actually have a couple lenders that will do anywhere from 5 to 10 unit properties. So normally in a normal world, those are considered commercial properties. But what I'm finding is that there's very few lenders out there that do the commercial loans on that type of a thing. You might have to really search long and hard to find financing on 5 to 10 units, especially if it's going to be, under $1 million, because institutional investors don't want that. They want bigger loans. They want $2 million loans plus. And then residential, we can go up to $2 million, but that only goes up to 4 units. So there's a big gap for the 5 to 10 units. So if you have a 5 to 10 unit property, you need a rate and term refinance or a cash out refinance, let me know, because I've got a couple investors for you that may be able to finance that loan for you. So all different types of properties you can use, by the way. So that's why I want to make sure I mention that. So no personal income or employment is needed for a DSCR loan. So I don't need tax returns. I don't need pay stubs. I don't need your business income. I don't need anything like that, right? That is separate from, this is a different type of transaction than the DSCR. For the DSCR, the things that we're looking at is just the cash flow of the property itself. So we're probably going to need lease agreements that you have on the property. It makes the most sense, right? And then if you don't have a lease agreement, maybe you're in between leases, what we're going to do is a short-term rental survey that's done during the appraisal process that's going to determine the market rent for us. And that's the number that we're going to use for our DSCR ratio. Now, that doesn't have to be the number that you rent it out for. Maybe you can get more rent than what the market rent is going to determine. And if you can, please, by all means, do so. But the number that we have to use is going to be the market rent coming in from the appraisal. Okay. There's no limit to the number of properties you have for DSCR. So you can do as many properties as you want. If you're an experienced investor and you have 10 finance properties, you can't do Fannie Mae and Freddie Mac anymore because they won't let you do any more loans because they have too many finance properties. But DSCR, it doesn't matter. We can find somebody that's going to lend on a property for you. So if you're in that space and you have 10 or more properties that are financed and you need loans, these DSCR loans is probably going to be the only way that you can go going forward, and definitely can help you out with that. Okay. The different amortization periods that we have, you could do a 40-year amortization, you could do a 30-year amortization, you could do a 5/1 ARM if you want to. Those are the different ones. And a 5/1 ARM is still amortized over 30 years, but 40-year fixed, 30-year fixed, and a 5/1 ARM. 5/1 ARM's pricing is not that much better in relation to the 30-year fixed, so you may want to just go with the fixed rate product to begin with anyway. The 40-year amortization helps out because we can oftentimes, without longer amortization period, lower your monthly payment to make the property cash flow. So if that's something you need, it's very unique. There's not a lot of people, a lot of lenders that will be able to do a 40-year amortization on a DSCR for me, but I have at least one that I know of, and hopefully we'll find some more come soon. So you can do interest only on these as well. Interest only means that you're paying, instead of principal and interest, you're just doing the interest, and you might need this to make the property cash flow, to make the DSCR 1 or greater. You also might need it to just maybe improve the cash flow. Maybe you just want to make interest only payment, and your exit strategy might be to sell the property in a couple of years. You want to maximize the cash flow of the property while you have it. That's definitely a reason that interest only is a good option for some people. It's not for everybody though. You need as little as 3 months of reserves. So whether you're doing a rate and term refinance or a cash out refinance, you're still going to need reserves. You can a reserve, just remember, is a principal, interest, tax, and insurance monthly payment multiplied by the number of months that we need. And usually, the better the credit that you have, the better the terms are going to be, the lower the amount of reserves you're going to need for the transaction. One great thing about refinancing, so with a rate and term refinance, we're going to need to have you're going to have your own funds. That could be in stocks, bonds, checking, savings, 401ks, IRAs, doesn't matter where the money is as long as you have it. And it's just used as a risk calculation for a lender. But on the cash out side of the refinance, sometimes you can use the cash out for reserves, which is a cool thing, right? So you don't have to have or document any of that other stuff that you have going forward if you're doing a cash out. As long as you have enough cash out to cover whatever the reserve requirement is, you can use the cash out for reserves. So that's pretty huge for a lot of people. Again, up to 80% loan to value for rate and term refinances. For cash out, we're going to need at least, we can probably go up to 75%. Usually it's going to be capped at 70%. There's a couple lenders that'll go up to 75% loan to value on cash out refinances for the DSCR loan, but you're definitely going to need, a really good credit profile to be able to do that. And the terms aren't going to be as good as they are if you're going to keep it at 70% loan to value. Credit score is down to 640. Okay. So that's not ideal. So you can get financing down to 640, but the higher the credit, the better the terms are going to be, and the more options and investors or lenders that we have for these types of transactions. So keep that in mind when you're doing this. There might not be as many investors or lenders or options when you're doing a cash out refinance at a 640 credit score, and you're trying to go up to 70% LTV. It's going to be hard, and it's going to be higher in terms of rate. Okay. So DSCR needs to be 1 or greater. The debt service coverage ratio needs to be 1 or greater in these types of transactions, whether it's doing a cash out refinance or a rate and term refinance. We actually have some products that will allow us to go to a 0.75% or greater DSCR. And those things are usually going to have better credit scores. And that means the property is not going to cash flow. It means that the income coming in versus the income going out is going to be, or the expenses going out is going to be less than the expenses going out. And that's not always ideal, but maybe you're in a market that has high appreciation and you're going to, take the small negative on a monthly basis because that property is going to go up in value, over the next year or two. And then you're going to sell the property for a big profit, and you had the tax write-off, you made somebody making most of the mortgage payment for you and it went forward. So that's an instance where that could make sense. And then lastly, there's also a no ratio DSCR loan. That's both for cash out refinances and rate term refinances. The no ratio means that it doesn't matter what the income is coming in on the property, you can still do a loan. However, the terms are not very good. Interest rates are going to be high. Reserves requirements are going to be high. And it may be, not the ideal scenario that you want to do, but for the most part, if you need to do the loan, because maybe you need the cash out to do this and doesn't, matter what the income of the property is coming in, then a no ratio might be an option for you. So very few people need the no ratio, but sometimes I'm just like, yep, that's a no ratio loan. You definitely need that one, right? In that instance, and it makes sense. So, don't discount anybody that may need something like that, because you never know what people's needs for cash are going forward. Maybe they have a great opportunity and they just need some cash quickly to be able to do that. The DSCR no ratio would work on that. So those are for both cash out refinances and rate and term refinances. And then remember, all DSCR loans for the most part are going to have prepayment penalties. There's some states that don't require you to have a prepayment penalty. But usually the interest rate is going to be on the high interest rate spectrum, because the lender is going to build that into the rate anyway, because they know that at some point you're probably going to refinance. So it could be a high rate to begin with. Prepayment penalties could go anywhere from 0 years, so no prepayment penalty, all the way up to 5 years. If you're on the lower end of that spectrum, that means the higher the rate's going to be in terms of the rates that could be available for a DSCR loan. If you're on the higher end of that spectrum, maybe you're up to a 3, 4, or 5 year prepayment penalty, then your rate is going to be on the lower end of the rate spectrum, because the lender is expecting you to keep the loan for at least that long before you refinance it. And just remember too that the prepayment penalty is a deterrent for you to refinance or sell the property within that prepayment period. Now you have to do the math, and you have to kind of figure out what makes sense for you. If you have a $100,000 loan and you have a 1% prepayment penalty, because maybe you're in the third year of a 3-year prepayment penalty and it's a 1% penalty, that's $1,000. Is that something you're going to trip over? Probably not. So you just got to kind of do the math and figure out what the prepayment penalty would be if you had to sell the property, if we had to refinance the property for a better interest rate going forward. So just take that into account when you're doing that. And I'm happy to run those numbers for you to see, hey, does it make sense, or does it like a big chunk of change that you don't want to eat right now? And then we can make the decision for that from there for you. Okay. And then lastly, the costs vary on these things. Again, it depends on the credit profile. It depends on the loan amount. They could be anywhere from probably 2 to 4 points in cost. On the lower end of the smaller loan amounts, they're probably going to have closer to the 4-point cost to it. If they are in the higher loan amounts, they're probably going to be even maybe less than 2 points in cost. But it just depends. And these come with DSCR loans and conventional investment property loans are always going to come with some sort of a cost for it. It's not the most desirable loan for the back-end investors, but it's a really, really good loan for investors, for you as an investor, I should say, not you as a lender, but you as an investor. And I think that these are really great products going forward. So hopefully that gives you an idea about the cash out refinances and the rate and term refinances that are available for DSCR loans. And if this is something that you want to chat about, whether you're a first-time investor or you're a very experienced investor and you want to, figure out how to move some money around on your properties, I'd be happy to be the one that helps you out. This is my wheelhouse. I love doing DSCR loans for all different types of properties all across the United States. I'm going to put my calendar link down below. So if you get a chance, go ahead and reach out to me, and I'd love to be the one that helps you out on the DSCR cash out refinances and rate and term refinances. Have a great day, guys. Bye.